Hi, everyone. We are here on our webinar series, How to Liquidate a Fund. Let me make an intro. I'm Mohammed Akram, founder of Akram Insurance Advisory and Tax Firm. I have a colleague, Stephen and Kevin Cott here, and also hopefully one of our client, Paul Weimer, would join us in a bit. Go ahead, Steve, make an intro, and then Kevin.
Sure. Good afternoon, everyone. I'm Steve Rosen, Senior Audit Manager at Akram Associates. Kevin?
Kevin, you're on mute, I believe.
Yes.
No.
There we go. Can you hear me now?
Yes.
Okay,
Yes.
sorry about that, everyone. I'm Kevin Cott. I'm the founder and principal at Cott Law Group. We're a boutique law firm that specializes in working with investment funds and advisors. We work with startup and emerging managers to large institutional fund clients, and really across all asset classes, everything from traditional hedge funds to commodity pools, private equity, venture capital, and real estate funds. We do a lot in the digital assets fund space. That's kind of us in a nutshell.
Paul.
Hi, everyone. My name is Paul Weimer. I am a founder and portfolio manager of the Amelyore Digital Assets Fund. So kind of a discretionary, long-only Cayman-based fund that has made a determination to liquidate. So that's how you get on one of these panels.
True. So before we proceed further, just want to a couple of housekeeping items that obviously every attendee will get the CP certificates. There will be a 3 polling questions, and you have to answer all 3 of them, and they will be very easy. So let's start the discussion overall. I think we should start with Kevin, because Kevin, usually law firms are the one who gets the clients first. When they launch the fund managers, when they liquidate the fund, they always reach out to law firms first, because these are all the legalities. So tell us, what do you think would be the best practices in this area, and someone reach out to you to how to liquidate the existing fund?
Sure. So I mean, it's, it can vary from pretty straightforward to complex, just depending on the fund structure and what specifics you're dealing with. But overall, I think from a legal standpoint, it's usually pretty well defined. You just look at the LPA and what the process is for dissolving a fund. It's usually pretty clear. What you have to do is first liquidate all the assets, and then at that point you can redeem investors, and confirm where the proceeds go to. A lot of that's done obviously through the administrator. You'll need to get, assuming you have an annual audit, a final audit distributed as well. And then on the back end, there's certain administrative filings that need to be made as far as, the certificate of cancellation for the fund. You'll need to contact the IRS regarding the EIN, contact the registered agent to discontinue that service. I think the key is just to make sure that everything is transparently done and documented, usually with, an investor letter that your attorney can help you draw up at the start of the process, kind of notifying them of what's going on, how it's going to proceed, the reasoning. The more transparency, the better. It can be a fraught situation if the fund's not performing well and you've got LPs that are, kind of looking for a reason to be upset. I think, a lot of it is just kind of optics and doing your best job to make sure that everyone understands how you got there and how the process will unfold.
Awesome. Paul, being a fund manager, what things do you consider that whether you should continue this fund or liquidate the fund, or when is the best time to make that determination? What parameters you think before?
Yeah, so that's a great question, Mohammed. And I think it's actually, for me, the most important part was when you, at inception, these are the types of things you need to be thinking about. I mean, it's easy when you start a fund to be kind of ambitious and think it's going to go well, and you've got the strategy. And but as you're setting up your service providers, you know, Kevin mentioned the documentation. Like, you need to review that and make sure you're happy with how they're setting up that liquidation part in case you need to. But then your decision on whether to liquidate, to me, I mean, to me, it was a question of, you know, the market environment changing, right? So just specifically with my firm in FTX, we were able to avoid the FTX catastrophe, but it severely limited my ability to trade, to have comfort in keeping my funds online. And for me, the decision had to do less about the losses. I think our performance is pretty well, and more about my ability to execute my strategy with the same risk profile that I'd raised money, right? And so to me, when you're forming the fund, when you're outlining your strategy, when you're working it into your legal docs, how you're communicating it in real time, you should always have in the back of your mind, what's our worst case scenario, whether it be for liquidity, whether it be for client expectations, and you need to manage that. And for me specifically, by being proactive with that liquidation decision, I was able to, I don't have any investors that have withdrawn. And so I was able to go and present to them a narrative on why the market had changed, why our strategy isn't, in my opinion, productive for the next few years, and how I want to set all of my investors on an equal footing, and the things I'm going to do for them in the future so that they can have exposure to this asset class. And then that allowed me to kind of take the reins and really dictate exactly how this was going to go and manage their expectations.
Thank you. That was a great informative discussion. Steve, my question to you is, when post fund manager decides he's ready to liquidate the fund and talks to the service providers, auditors, the fund admin, the tax, what things that these service providers should be doing to make sure that they're not dropping a ball, anything, right? And obviously the law firm needs to be get involved too, but from an operation side, the last audit, the last tax returns, all those things, what should really look into that?
Well, the first step is coming up with a plan to actually liquidate your positions.
True.
Right? Because if you can't liquidate your positions, you can't pay your investors back, right? So you have to have some roadmap to liquidate those positions and communicate to the investors and all the service providers, you know, an approximate timeline of how long you think that's going to take, right? Because once that process begins, they can start to begin to, you know, pay all the outstanding invoices, you know, and start giving out money to the investors. And, you know, figuring out that timeline and unwinding those investments will also give you a better handle on, do I have the ability to pay the investor back their full capital balance as of the day I say we're going to liquidate, or is it going to be pennies on the dollar, right, depending on the investment? So to me, that's probably the number one thing, just communicate, having a plan to liquidate and communicating that to the investors and to all your service providers, because they really, without that, they can't do anything.
Okay, but obviously the make sure there should be a checklist, right, where when the fund decides to liquidate, make sure they're preparing the final tax returns and all the K1s and the final audited financial statements. And then question comes to Kevin, to you, right? So obviously a lot of people say, okay, I'm done, close the bank account, brokerage account, audit, tax return, but sometimes they even miss to file certificate of dissolution with the Secretary of State, right? So what things you really look at when you recommend that they're liquidating properly?
Yeah, it's a good point because a lot of times the sort of like minor details at the end get forgotten about, and sometimes they'll at this point want to just save on fees, and there's such a thing as letting the entities administratively dissolve. But then you get into legal issues about, like, I think there's, depending on where you are in certain circumstances, that can open you up to additional liability versus just affirmatively dissolving it with a certificate and actually paying the filing fee. So little things like that, you just, at this point, you're looking to close it as cleanly as possible. And so I wouldn't take any shortcuts. I'd actually have your attorney or whomever help you submit those filings, contact the IRS, and make sure the entity is legally closed in addition to just administratively.
Right. So my next question is for Paul and Steve, that when they liquidate the fund, they have two options to distribute the capital, right? One is obviously distribute cash, because when they contributed in the fund, they gave you cash. And if they want to redeem, the final redemption would be cash too. But sometimes, are there any pros and cons of making in-kind distribution? Instead of liquidating the portfolio and giving them the cash, is there a better way sometimes to give them only the securities in the portfolio? What your thoughts are, Paul? When you were having this liquidation with your investor, did you talk to them? Are they interested in cash? Or what were the discussions you had with them?
Yeah, I did. And so I would say the first step is to understand the functionality of that decision. Your documents that when you set up, if it's been a few years since you set up, it might not even provide that you can do in-kind distribution. So you need to check that. The second is really understanding that your fund administrator can do what you think you can do. I can't stress enough that you can have a great fund administrator, you can have a great capability there, but you should not be communicating to your investors what you can do for them until you know that you can do that for them. And so that's the first thing that I did. It was like, okay, I reached out to Mohammed, what can I do? Like, can they take in kind? And then the second part is understanding what that means for them. And then I'd throw a real caveat here is you've got to be really careful in how you translate that to the investors, because you don't want to be doing the accounting role. I don't know how you have to give advice to your investors, but you don't want to you don't want to get out beyond your skis, and you also don't want to just necessarily turn complex things over to their accountant to answer for them, right? So I would even encourage you to have a conversation with Steve and Mohammed and say, like, look, I'm going to have 30 investors with these specific questions. Maybe as a service, I can engage you to answer them so that you don't take on that liability. But in my area, like, I've got pretty complex products that their accountants don't really know, and so that I don't want their accountant answering the in-kind question. Keep in mind, just in the back of your mind, how do I help get the best answer from my investor, and how do I make sure that I'm not introducing legal liability? And if you keep those two kind of axioms to your roadmap, I don't think you can go wrong. Like, you're not the first person to go down this road. Don't get out saying things that you don't really have control of.
True.
Yeah, I would second that. I think as the attorney on the call, I don't want to overstate, the importance of being thoughtful in what you communicate to investors, and less is more, and being risk averse. But there is a time for that, and I think when you're closing down a fund, and that could be a situation where you do have losses or investors that, if they're litigious, would be looking for something to harp on. Something that's poorly communicated could be could really be blown out of proportion. And so I think taking a lot of care in how you communicate with them, and as much as you may want to be totally open and make them feel better, you really want to have it run through your counsel and your admin and your auditor, and make sure that it's being properly communicated in a way that doesn't open you up to more liability, because I think it's a situation where it could be a little more at risk than you are maybe at other times.
Can I just?
And I would just like to say that keep in mind, everyone, that just because you're liquidating a fund doesn't necessarily mean that the fund is in a loss position, right? The GP may decide, you know what, I'm doing this 10 years, I'm done, right? And you're sitting there with appreciated securities or appreciated value, right? In a case like that, you might want to consider, especially if you have a pretty liquid portfolio, you might want to consider distributing securities as opposed to cash, right? Because cash is immediately going to trigger a tax event, right? If you distribute the securities, you're going to be able to get or potentially get some kind of basis adjustment for it and kind of kick that can down the road.
Great point. Yeah, I would just kind of following on what everyone said here. I mean, you start to see a theme of how you interact with your investors through this entire process is what's going to make whatever message you need to deliver relevant, right? When you're under pressure, whether from losses or whether from whatever decision you make, you're going to have investors that are going to put pressure on you, either for information or for different things. I mean, some of it's ridiculous. Like I had one investor who got into my fund, and he got in at a time where he was more disadvantaged than his business partners, and he asked me if we could just give him a little more. I mean, that's ridiculous, and of course you wouldn't do that, but just be aware of, like, you're going to get all kinds of requests when expectations change, and it's not just what you're communicating, but your ability to communicate that equally. My largest investor never misses a chance to let me know their largest investor, right? They might want different things because of that, and so it's not just the information, it's that you can demonstrate that you've not given anything advantageous to a different pool member.
Kevin, you brought a very good point. The legal liability when fund manager communicates the decision regarding the liquidation. Is there any best practice in that area? What fund manager should communicate, what they should not, what form of the communication should happen?
Yes, so I think that's where we're limiting the communication is key. You want to be, communicating and available and obviously not unresponsive, but I think that's where it's really important to put together an LP letter where you run it through legal counsel, you frame it the exact way that you want to frame it, the information is accurate, everyone is clear on what's going to happen, and you have sort of a streamlined communication process on how everything is going to unfold, and then not be firing off random emails to different LPs where each email is a little bit different, and then you can have inconsistencies and someone saying you said this on a call. You just want everything properly documented and vetted.
Means the written communication is a better way rather than over the phone or the calls. But sometimes even they receive the email, they still would like to talk to the fund manager. And what should?
Yeah, I mean, I think written communication is best in terms of having one mode of communication where it's consistent for each LP. What I would be more concerned with is just kind of doing everything via email where you have different emails, because that's also in writing. But if it's inconsistent, that's problematic. I don't think you should be opposed to speaking to your investors on the phone. You just want to be careful and not misrepresenting anything to them when you speak with them.
Right.
It goes without saying, I mean, that you take a meeting note and your investor relations team has bullet points, instructions, meeting notes. So This is kind of that natural tension between a fund manager and their lawyer, right? Your lawyer is going to say, don't communicate. These are people that you've built long-term relationships you hope to have with again. I do think that the personal touch for me has been beneficial, but I have crossed every T, dotted every I, and done that in concert with kind of real written uniform items. And I mean, I don't know exactly how it is for the US, but I've also really relied on my board of my Cayman fund for the directors to hold my hand through that, to make sure that they're kind of involved and working with the legal so that those messages have kind of director approval. So if you think about this in T+5 years, you want everything to line up. You never know when someone might have a legal thing. To Kevin's point earlier, like the thought of not paying to close your fund, not just for your liability, but for your own investors, like seems peculiar to me.
Yeah.
Like you need to have a budget for these scenarios, and it seems like an absolute no-brainer to write that last few checks to get this buttoned down.
Yeah, I mean, you always hear about politicians staying on message, and obviously you don't want to view yourself as a politician here, but the staying on message is a good point. You know, you want to know what it is you're trying to convey and be consistent with that. You know, not because you're running for office, but because you're trying to make sure that you don't say anything wild that can then later be used for legal liability. And so I think just knowing your message and being consistent is really key.
Right. Okay, awesome. So, Steve, you touched one area that distribution in kind makes more sense tax-wise if you have a lot of appreciated securities, right? What if most of the time fund manager liquidate the fund because they have losses and the high watermark, the economics of the fund will not work? And what other scenarios do you think distribution in kind makes sense? And my next question to Kevin is it okay that if fund manager liquidates the existing fund and open a new fund, right? Is there a certain time period they need to do that, or what the optics look like, what the legality looks like, because he's closing on the fund because he has a huge loss carry forward. He may not be able to earn huge sum of money in the coming year. So let's start with Steve, and then we can jump on Kevin on this.
Right. So if you're sitting in a loss position in the fund, and again, if you've got fairly liquid securities that anybody can just, you know, go to the market and, you know, cash them out, I don't think that there's much of a difference if you're going to give them cash or, you know, give them the security, because it's essentially, it's going to have the same effect to them, right?
Yeah.
Right. You're just, you know, you're just delaying until they actually sell the security and then they have the cash event, right? Right. So they're still going to get, you know, to take or, you know, put on their tax return the losses, whether it be, you know, via the depreciation in the securities or the, you know, loss on disposition of their partnership interest. Either way, it's going to go the same, right? So as long as you've got securities that are, you know, liquid that you can get rid of quickly, I don't think there's a big difference. It might actually be even easier just to avoid the step of converting to cash, because the brokers can always transfer securities to somebody else's brokerage account, right?
I know, thank you, Steve. That was a good insight. Before we jump to Kevin on the question I asked, let's go for a poll because it's been almost 26 minutes. So I'm going to start the first poll. Okay, that was easy. Kevin, please answer the question. If you want, I can say one more time
No, I recall it about closing down a fund and then opening a new one.
Yes.
So the short answer is yes, you can open a new fund. There's a few things to consider, and I probably should have brushed up on the rules ahead of the call. But the main things to keep in mind are, one, I guess just kind of marketability and optics. So if you're pitching to the same investors, and let's say you were down in the fund, and then you want to restart with a new fund, obviously there's going to be some concerns there about suddenly starting with a clean high water mark and not making up the losses. There are certain legal issues like integration if you have two identical offerings, depending on timing. So maybe this fund's a little bit different in terms of learn something and you have a slightly different strategy. There's Securities Act rules under like 506B and C and how you're marketing it. So it does depend on specifics, and you do want to not to say talk to your lawyer, but you kind of need to talk to your lawyer about whether it works in your situation. But in short, you can certainly close down a fund and launch a fund. It's just whether you're, how you do so and your ability to raise money in it.
Okay. So there's no illegal issue if fund manager closes down the fund and start a new one with a different investment strategy or different. But if he does the same thing, right, closing down the fund because he may not be able to earn incentive fee for a while because of the huge loss carry forward. Optics will not look good, but do you think this is also illegal too, or it's illegal? But
yeah, it depends on a few things. There's track record issues and how you have to market it. Whether you're an investment advisor or a commodity pool operator, depending on your registration status. So, I'd probably need to double check some specifics regarding which situations would permit it. But I guess the answer is it depends. But typically, you can do it with full transparency and disclosure.
Okay. Paul, what do you think being a fund manager? When you suppose, obviously, you're closing down the fund, you're not going to earn a management fee and the incentive fee from those investors in that fund. But what things comes to your mind that if you're going to start a new fund, whether it would be the same or different, or how would you approach to the investors again to raise capital from the existing one? How would you position yourself in a better way to make it
right? So the first thing is when you decide to start a fund, you start down this path of service providers, right? And if you don't, then I would argue maybe you shouldn't start a fund, because if you aren't thinking through your accountant, your fund administrator, all these things, you're probably not quite prepared to manage pooled assets. But once you get that, then you're out into the forecasting, right? You're saying, all right, it's going to cost me $240,000 in the first year to get this thing off and going just from the admin side. That means I have to raise this much and produce this much of fees, and you're automatically kind of running these numbers, right? Which is totally great. But as part of that, you also need to be running the what if the market doesn't do what I think, or what if, and the answer you'll get a lot of times is, oh, well, we have these gates so we can wait for the market to come back, or, but think about what a gate does. Like if all of a sudden I can't get my money because my fund manager isn't happy with what the market's doing and they put me in that position, right? So you should always be kind of managing your tools and your investor perception, and you should be thinking like, what if this goes 100% not the direction I'm thinking, and plan for it, right? And so that's liquidity. That's, you're going to be making great money if you have a carry in your great years. Like, how are you preserving money for your not great years? And I was in the UK working in finance when 2008-9 happened, and really good productive hedge funds shut down just because of redemptions, right? So I would assume an portfolio manager's already running real-time liquidity things so they can account for that. But my decision to close, I actually made it fairly quickly after FTX, right? Like I felt like that changed my entire thesis. It changed my understanding of the risk parameters. It made questions about how I bank for my investors real relevant, right? And so I have illiquid positions. So, but I was able to kind of come up with a plan for those liquid positions. I'm glad I never lost track of what's liquid and not liquid in my portfolio. I mean, I can't even imagine if your redemptions outrun your liquidity, what kind of investor sentiment you're managing at that point, right? So for me, I chose to do a partial redemption. So I'm like, look, this is what's changed. I made a partial redemption at the end of the year. I clearly explained the liquidity, the variability that's involved with that. And then I did something because I just said, look, we're now in a more passive strategy while we unwind this. I'm not going to charge management fees, right? And I can do that because when it was good, I didn't think it was always going to be good. And this small investment in my clients during runoff, I think is allowing me to, I've had multiple say, let me know when your next one, right? And so I don't know, long story short, it's a mindset that a portfolio manager has that says, my investor is what matters. My investor is what's going to make me the most long-term value. And then making every one of these decisions with that in mind, right? So when you close down a fund, it's being able to sit there and let someone yell at you and be able to say, hand on heart, this is the right answer for you. And I know that and have a track record of that. And so my only thought is it's how you raise the money in the first hand, right? That sets managers' expectations. It's knowing as much as you can know and then communicating a little less than that. Like, I love my administrator, but like they haven't been able to execute things quite like I like, right? And so I don't need to have blowback because of that. So I've managed those expectations. I just think it's part of your decision making and how you operate and communicate each month kind of buys you the goodwill to deal with this. And then I would also say, like, we've talked about like closing it down for good, closing it down for bad, like when you're ahead or lost. But I also think you always need to there's also a transaction element to this, right? Like if you wanted to sell a fund, or like when I decided to close fund, people have come to me and said, well, we'll buy your remaining assets, or, you just have to keep the investor in mind first and make sure you're never making a decision that's for you and not for them. And I think that working with your service providers probably would have helped you avoid most of any fallout that could happen.
Yeah, I was going to say, I think that ties into the question about, opening another fund, optics wise, right? So if you've got someone who is proactive like Paul and decides that they're going to close the fund based on changing macro conditions, then, when those macro conditions change, if you go back to investors, that's a real pitch. Whereas if you've got someone that is floundering and closes the fund and then immediately wants to reopen a new one, you're gonna have a really hard time raising money because you can't give them a good reason why it occurred. So I think being thoughtful and again, having a message goes a long way, not just short term, but long term.
Right. And I just want to say it goes back to 5 words that tend to get investment managers in trouble because they forget these 5 words, right? Fiduciary duty to your investors.
Yes, that is a very right word, fiduciary responsibilities for every fund manager.
Mohammed, can I just make one last comment? Perhaps a good way to think about it, if you're an existing manager, is to develop your liquidation criteria now, right? So if it's, I can imagine a scenario where if you have a slow bleed redemption, that like I can see you getting into a worse situation as far as investor sentiment and finances, right? If you run these out hoping for a prayer. I mean, I think having that clear criteria of like, look, if my assets meet this, ever get to this point because of redemptions, then I need to take these actions. You know, you don't want to find yourself in a position where you're letting everything else dictate that, because I don't know, it just doesn't seem, it seems like a way to really put yourself in a harmful situation. So think through what you want to do, have your plan, and then adapt that over time. It'll allow you to be more actionable when crises come.
Before we proceed to the next question, let me go for a next poll here. Yes, the question we asked was that what is the first step in liquidating a hedge fund? And the first option was talk with the hedge fund service providers or inform your investors. So 80% attendees mentioned talk with the service provider, which is the right answer. Informing the investor should be the final step or the next step. But you should not reach out to the investor telling your decision without discussing with the law firm and fund admin and the auditors that this is what you are thinking, and get some their insight before you make a decision. Okay, so next question is more obviously, Paul, you are in the digital asset space, but I think Kevin has a lot of experience in that space. Have you guys seen recently more liquidations happening in this sector, or it's across the board? Because I'm getting calls from CPO, CTAs, digital assets are on the top. They're liquidating the fund and they're asking for the audited financial statements. Just want to get your insight.
Yes, I mean the FTX fallout has been disastrous. You know, it's been really tough to watch for a lot of our clients in the industry at large. And you see, you know, a lot of different scenarios play out. There's funds that lost that had a lot of exposure to FTX and it wiped them out. There's funds that had exposure and are trying to kind of figure out how to continue. There's managers that are, you know, the casualty of the macro environment because of it, even if they didn't have direct exposure. There's, you know, some managers that kind of sheepishly did well if they were, you know, negative or you know, short or kind of played on the volatility. You see everything, but I think overall we've definitely seen a lot of fallout, you know, and a lot of managers kind of figuring out where to go from here. You know, it certainly, it gets referred to as like the second crypto winter, and it's, you know, we're in the middle of it. So definitely more in the digital asset space. You know, I think there's some cautious optimism about, you know, it rebounding at some point in the future, but for now it's a tough environment.
Right. Paul, what do you think the digital asset space, obviously, as Kevin said, there's a lot of liquidations, but what do you think about the crypto winter? Do you think it will last for another year or 6 months or a couple of years?
So great question. And I would say that, like, for me personally, who's been through a few crypto winters, I'm not put off by that, but the capital appreciation story that I've really believed in relates to normalized regulation and institutions coming in. And as those two things happen, there's how we get the next 3-4 trillion into this, right? And I think FTX was absolutely damaging on both those two fronts. FTX was predominantly an institutional exchange. I think SBF led the regulatory push in Washington, D.C. From a U.S. perspective, I think it's like 180 degrees. Now, I'm a technologist who believes that this tech is 100% a superior way to organize a lot of transactions, but I think you're going to see builders move back. I mean, there's nothing novel in this, but I think you're going to see builders really attacking use cases, and the demand will come. I think it might be just a little bit more sustained than we're prepared of. We haven't unwound the wider macro situation yet, the wider macro backdrop. So those things represent headwinds that I think as a fund manager, and circling back to our topic, you need to take an opinion on, and you need to run projections and see where you think this is going. But yeah, I think we're, it could easily recover, but it also could easily flounder for a little longer because of these core things. The ultimate positive thing I have is that there is venture money in this space that's going to fund the builders who are creating the products, which are eventually going to attract the capital. So I don't think, each one of these winners feels a little more like it can recover. But in my opinion, I feel like the FTX thing set this whole space back by 3 to 5 years. So.
Yeah, the irony of that is, it's really a financial fraud story, like as old as time. It's not about the underlying technology, but the impact, is across the industry.
Right. I am forcing a lot of acquisition and mergers, and in this space, matter of fact, we are trying to work as a financial advisor on one of that project. We can't announce to tell who the parties are, but Steve, tell us a little bit color in that space the firm is having on the digital asset space, and also the liquidation, where we see the most liquidations are happening in the space.
Say that again. I didn't fully get the question.
I'm saying if you can tell us about our firm, that where we see liquidations are happening. Is this in the digital asset space, or in different hedge funds, or VC world, or where you we have?
Oh no, that's easy for us. We're seeing funds that have opened and closed in the same year, right? In the same accounting period, right? All due to the digital assets, right? Even in the past, you've seen a fund here, a fund there. I think maybe in the last 3 years, if you exclude out any digital assets, we may have seen 1 or 2 funds wind down. And that was, a mix of, one had poor performance and the other one just decided they had enough. But after the digital asset debacle, we're seeing 3-4 times that amount in a year. Like I said, we have funds that came to us at the beginning of the year, and now we're telling us we're winding down. So it's gone up exponentially in the current year, right. Meaning 2022.
Right. I think 2022 was a bad year across different asset classes. It's not only digital assets, equity market, bond market, fixed income, real estate. Everything was down because the Federal Reserve was increasing the interest rates, right? So what I see more from my point of view on those prospects calls, that this liquidation is happening across the board. I don't say that only limited to digital assets. We got a couple of calls yesterday. Some CTAs were closing down the fund because that strategy is not working in this high interest rate environment. Because when they launched the product, interest rates were ridiculously low. Now they are at 4 or 5%, right? So how they can manage the whole strategy? So they're just closing down the fund. So I think it's good and bad. Means this is how we see every cycle. When 2008 happened, a lot of people said, "Oh, hedge funds are dead," right? No one's going to. But I think assets are increased in that space. And I feel like the same response to digital assets too. A lot of people are saying that market will cut down. Yes, it had already cut down, but I don't think so it's that. It will alive again, and it will be thriving in next few years. So as long as technology is there, as something is wrong with the technology, God forbid something happens in that space. I'm talking the digital assets. If somehow technology is not really good, or there are some cracks in the technology, that's a different story. But I don't think so. FTX can really stop the growth, but it can definitely delay the growth, as Paul said, that put the industry back because there was a lot of optimism over there. So my last, I think we only have 4 or 5 minutes left. I can ask the last poll, and then I can ask the last question to all my panelists, and let's see. Okay, the polling question we were having was, is the final audit completed prior to the actual distribution of assets? So 60% said yes, 40% no. Steve, what you think? Who's right here?
Oh, the people that said yes.
Right, but do you think in certain cases no could be right too? Like
it could be, but most of the time it's done before the final distributions are made.
Right. Paul, tell us about your situation in your fund. Are you going to wait for the final audit to distribute the final distribution? You're getting a waiver, because sometimes fund manager likes to get a waiver. They don't want to pay a final audit fee, right? We can touch with Kevin on that, but what's the strategy you are?
Yeah, so I am postponing, I'm doing the extension. So I've applied because I'm mid-year. I have a little variability because my illiquidity has to do with Ethereum staked in the ETH2 contract, which is variable on when it will actually become liquid. And so I am extending this year's audit. I'm also probably going to buy out a small amount of the really illiquid positions through my board to kind of, with my own personal, to kind of bring it to a close. But so I have a little variability. So what I'm doing is getting everything from an audit perspective. You know, we talked about your fund administrator, your accountant, your auditor is also one of your first calls. And you're going to talk to them about what, why, and let them work through this with you. But so we have a plan so that they can almost do it in real time. When it all comes down to will the distributions happen first or after, it's at least in their court to decide. But they're very aware, and we're keeping them up to date.
Kevin, my question to you is, a lot of fund managers don't want to spend money on the final audit because they lost the money, and they just, what is the requirement of waiver in different jurisdiction? Can you give us some color on that?
Well, it depends on a few things, you know, how you draft the documents. If you, you know, are promising an annual audit, including upon closure of the fund. If you are a, you know, registered investment advisor or commodity pool operator, you might from a regulatory perspective, be required to have one. But if you're in a situation where where you either are not required to, from a regulatory standpoint, and either you know, are not having an annual audit, or more likely you do, but you want to ask your LPs to waive it, you can request their consent. But you have to see what you have to, specifically as an investment advisor or a CPO if you're trading futures, it may not be something that's on the table for you.
Right. What about the offshore jurisdiction, BVI or Cayman?
What about there?
Yes.
Yeah, so if you have an offshore fund, well, I think that depends as well. So like, for example, if you're in the BVI, there's incubator, approved fund, professional fund, and different requirements for each one. Somewhat sheepishly, I think I'd have to double check the rule for each one and speak with offshore counsel, but it depends.
Kevin, I put you on the spot on a lot of different things.
No, that's all right. I think, but it depends on the jurisdiction and which type of fund you are there.
Right. So I have one more question on that. So even though you may not be an RIA at the SEC level, if your state jurisdiction deems you an RIA, do you have to follow what so if they tell you need an annual audit, even if the LPs are willing to waive it, do you still have to do it?
Yeah, so if you're registered at the state level and one of the requirements is an annual audit, unless there's something in the regs that allows you to obtain a waiver, you have to check that very closely. Because if you're not permitted to do so, you're not permitted to do so. The rules vary by state. If you're an ERA, for example, you might not have to have one. So it just depends.
So what are the rules on the digital asset side, right? If they're not registered with this even state, right?
It's not going to really change anything, because if you're taking the approach that the digital assets are securities, then you're an investment advisor, same as if you're a hedge fund. If you're trading crypto derivatives or something that brings in CFT jurisdiction, you're a CPO. So it really just depends how you're approaching those assets in terms of classification, and then from there you just look at the traditional rules.
Right. Okay. One final last question, and I think we will just close the conversation. What is the main theme or point you guys give to the audience or attendees that when they liquidate the fund, what is the most important thing a fund manager should do that? I would start with Paul.
The most important thing to me is to realize that liquidating your fund is part of your choice set at any point given your fund. And so you need to be strategic about that tool. Once you do apply it, you need to turn yourself over to your service providers and have a step plan that's well choreographed so that you can go exit on it. There just seems like a lot of ways you could mess this up with good intentions, right? So you have to kind of dig in a little deep during difficult circumstances to really just do this by the book.
Yeah, I'd sort of have the same thing. If there's a time to lean on your service providers, this is one of them. I don't want to say it's high risk, but if it's unfortunate circumstances, you're looking at LPs that might be looking for a reason to be upset. And so being deliberate and thoughtful and on message and making sure that you're documenting everything appropriately. You should always do that, but this is an especially prudent time to do it.
Right, and for me, whatever decisions you make, just make sure that you look at the flip side of the coin and that you're not disadvantaging any investors. Make sure you're doing a fiduciary duty to every investor the same across the board. Because if you don't do that and somebody gets wind, then you're going to have a problem.
That's a very good point. Being an accountant, I want to make sure that you are not dropping the ball and like getting the audited financial statements, filing the final tax return, dissolve the fund in the state of Delaware, dissolve the management company. All those things are your finish line. Make sure you are touching your finish line. Awesome. I would thank you, Paul, Kevin, Steve, for this very insightful information given to our participants and attendees, and wish you all the best. Thank you.
Thanks, Mohammed. Thanks, everyone.
Thank you.